Good day, ladies and gentlemen. This is Barry Norman on behalf of USG, and welcome to our webinar today. USG is our sponsor, and of course we're brought to you by investing.com. And today we're going to be discussing technical analysis on candlestick charts. Now, as I said, our webinar is sponsored by USG FX out of Australia. They are the leading Forex provider and CFD broker out of Australia that is regulated by the Australian authorities. So you know you're dealing with a trusted broker. So you know you're dealing with a broker that is regulated by the Australian Securities and Investment Commission. All your funds are segregated, so you never have to worry about your money. You get quick withdrawals within 24 to 48 hours and about the fastest trade execution speed of any platform around the world. They have servers placed around the globe so that you get ultra-fast one-click trading. They also have negative balance protection, and you get a dedicated account manager. So what more could you ask for when you want to trade successfully? As long as you have a support team and all the services you need, you should be able to turn your trades into successful profits. Now, they offer up to 500 to 1 leverage. They have low spreads and slippage. There's 60 different currencies and indices you can trade. And they offer minimum deposits of $100. They also provide you professional charts, trading alerts, and technical analysis from Trading Central, Zulu Trade, and My FX Book. You can get all of this directly from USG. They were named the best broker in Australia in 2015, 2016, in all of Asia in 2016, and it looks like they're going to keep on going with 2017. So they offer many different services and platforms designed specifically for you. You can choose and select how you want to trade, what you want to trade, what type of platform, whether you want to download an MT4 or trade online. You decide what fits you the best. And you know you're dealing with a global company who is headquartered right there in Sydney, Australia. And you can trade CFDs on equities, indices, and commodities like gold or silver, or you can trade Forex with 60 different pairs. They've been around since 2006, and in the Forex industry, that's a long time. They're one of the granddaddies of online Forex trading. And again, you know they're regulated, so that means you're safe and secure. You can check them out by going to the Australian authorities and look for license 302792 under the Australian regulators, and you'll see the history, and you'll see that they are very well respected. They offer the MT4 and MT5 platform, MetaTrader Mobile, WebTrader, and multi-terminal. All of this can be yours. You decide which way you want to trade, how you want to trade, what services you want. You get daily technical reviews. You get trading signals pushed directly out to the MT4 platform. You get online technical research plus Forex TV. So you'll be aware of everything that is going on in the market. You'll also be invited to their Traders Club program, offering a full suite of very unique products to help you trade better. You'll be invited to their Traders Master Classes. You'll get tools and alerts and signals. You'll get up-to-the-minute videos. What else could you ask for? And right now, if you open up your account, they'll upgrade your account to Traders Club. They'll give you Trading Central services, and you'll get a $500 bonus for a $5,000 account open. So this is only for webinar attendees today. So go open up a demo account at www.usg.com. and open up your demo account. There's no credit cards required, no deposit required, and you can romp around their platform and see how nice they are and then decide if you'd like to start trading with them. Now, today's class is being recorded, and you can access a recorded version of today's class in about 24 hours by going to investing.com, locate the Education tab, and then find Webinars on Demand. In fact, you can watch all the webinars we've ever presented right there on the Webinars on Demand tab. So go over to www.investing.com and see a recorded version of all the webinars we offer. So let's get started. Let's start talking about technical analysis and candlesticks. Now, traders who subscribe to technical analysis operate under the fundamental theory that prices move in patterns and that prices never lie. To the inexperienced eye, a financial chart may look like an unpredictable line with a jumble of colors and marks, but these traders are watching charts to pick up the subtext, the subtlest change in an indicator of where share prices or asset prices could be headed next. So first, before we look at actually the charts, well, we're going to go back and forth, but we need to understand what these different indicators are, because I found over time that many traders don't know the different classifications of technical analysis. They also don't understand chart patterns. And chart patterns, whether you're dealing triangles, rectangles, head and shoulders, are also all parts of technical analysis. Now, some of these take a lot of time, so we have a whole class of just chart patterns and trend patterns, because I couldn't even cover all of these subject matters in one class. So today what we're going to be talking about are the indicators we use, like RSI, MACD, Bollinger Bands, and where they fall and how you would combine them into a strategy and put them on your charts to make sense of what's happening in the markets. Now, the main similarity between technical analysis indicators is that they work on all security prices, and they use the open, the high, the low, and the close, and a lot use volume in their calculations. Now, they fall into many different categories, but technical indicators may fall into two predominant categories, and this is crucially important to understand in order to apply them to successful trading strategies and to properly put the right ones or use the right ones on your charts. And we have what's called leading indicators and lagging indicators. Yeah, I know most of you didn't realize that there was a big difference between these types of indicators. You just thought, oh, I'll use RSI and stochastics. My buddy told me stochastics is great. And MACD does some wonderful things, so I'll combine them together in a strategy. Okay. But it doesn't work that way. You have to understand what categories they fall in so that you can understand what they're telling you in conjunction to price action. So leading indicators are those who lead price movement. They help you predict. They give you a signal before a new trend or reversal occurs. So they're quite important because they keep you in front of the markets. If you're in the market, they're letting you know it's about to change, so maybe it's telling you to get out. Or if you're looking to enter the market and you're waiting for the trend to reverse, like for instance, we've seen Bitcoin skyrocket as high as 62.39 or 62.89 yesterday, and it's been in a steady uptrend. But we're waiting for a signal to say that this uptrend is over, that the too many traders, the market's too heavy, the price is too high. And when you get that signal, you might want to go in and sell Bitcoin to go down. Or it might tell you that the trend is still remaining strong. So even though price is easing a little bit, it might tell you it's an entry point to grab in to continue because the Bitcoin's going to continue on its rally. Now, lagging indicators, and this is a great deal of the technical indicators, are those who follow price action. So lagging indicators are always slightly behind price. They will give you signals after the trend or the reversal has started. So one tells you it's about to reverse or continue. The other tells you it has already done this. So indicators from both categories belong to one of the following types. And now, once we've decided which are leading and lagging, we have to figure out what category or what type of indicator they are. Because we don't need 3 indicators that fall under volatility indicators or volume indicators and neglect momentum or trend indicators. They also tell us different things. So this is why it's very important to understand what type of indicators or what type of technical analysis you're going to use with your candlesticks. Candlesticks on their own give you a lot of important information, but they are not, indicators are your secondary defense level. They are your secondary indicator, the secondary line of defense that tells you, supports what you're seeing in your primary line. Now, indicators fall into these 5 categories. So, number 1 and the most predominant and the most well used are what we call trend indicators. Identifying trends over time frames are useful because it will help weed out all the noise of daily volatility. Any type of trend, including uptrends, downtrends, and sideways trends, can be traded for profit so long as it's shown itself to be consistent. Trend traders use a number of different indicators to help them figure out what kind of trend of a stock is in or an asset is in. one of which is the most popular of indicators is moving averages, which is represented by a single line that represents an asset's average price over a given period of time. A 50-day moving average or a 200-day moving average are the most commonly cited. Now, when we're talking about moving averages have been around forever and a day, and they tend to be cited in this 20-day moving average or this 200 or 60-day or 90-day. But what we're talking about is not days. If you're using a daily chart, then it's days. But it's too hard to say a 50-period moving average based on the time frame you're using. But if you're using a 15-minute chart, that moving average would be not 50 days, but it would be 15 bars of 15 minutes apiece. Other examples of trend indicators, though, include my favorite of all times, MACD, moving average convergence and divergence, average directional index, parabolic SAR, and linear regression. But out of that, the two most popular are ADI, average directional index, and MACD, convergence and divergence. Okay. Now, these are called trend indicators. Okay. Now, we'll talk a little bit more about these and which are leading and lagging and how to use them in a few minutes. First, we're going to break down the 5 categories. Then we talk about volume. Volume is crucially important because volume supports whatever is happening in the markets. In other words, if volume is the amount of traders jumping into the market, the amount of contracts being issued, the amount of shares being bought, okay, that needs to support your trading decision, because if an asset's going up, you've got a pattern in say you got a bullish engulfing pattern in your candles. You got an entry point, and you see that, but the volume is not moving with the direction that it should be, or volume's not increasing in an uptrend, or there's not a standard ratio between volume and price, then you got a problem because the traders are not supporting that movement. So it's very important that we look at volume. So sometimes market conditions and other lack of liquidity alone can temporarily drive its stock or a security prices higher or lower. However, these moves often occur on relatively low volume and can be short-lived. On the other hand, if a security makes a big move on extremely high volume, that's a reliable signal that there are major buying or selling going on, and the move should be taken seriously. Third major category, and it's one I use a lot, is momentum. Because if you're a short-term trader, you want to see that that asset has momentum. Because if you're a momentum trader, that means we don't really care whether the asset's going up or down. If it breaks out going up and it's got the momentum, we're just going to take that trade going up. And momentum is very, very important, because any action without any momentum means that it may not move enough to make any profit for you. But momentum indicators are like speedometers for traders. They show how fast an asset is moving in any given direction. These indicators are typically displayed as what we call oscillators, which fluctuate above and below a baseline level to indicate how much positive buying or negative selling momentum an asset is experiencing. Arguably, the most popular of the momentum indicators is that of RSI, Relative Strength Index. RSI is represented on a chart that tracks a stock's price in a scale of 0 to 100. Now, there are many, many indicators that fall in this category. This means that their calculation, when they're calculated, fall between a very specific zone. So RSI, whenever you do the calculation, will come out to 0 to 100. So will stochastics. Okay, it's always within the zone, and a price above a certain level in a zone tells you something, and a price below a level in that zone tells you something. Now, these are what we call bounded indicators, because they are bounded within these numbers. Now, most are 0 to 100, but that doesn't mean they have to be. So like RSI will always come out between 0 and 100. But when you put it on the chart, the only important numbers are above 70 or below 30. So if the stock moves above 70, it's considered overbought, meaning that there's too much buying pressure on the asset and it should fall lower. If the price moves below 30, that's a signal that the asset is oversold and buyers could soon come in and drive the prices higher. However, it's worth noting that RSI can sometimes stay above 70 or below 30 for a very prolonged period of time. So there are many different types of momentum indicators. You would have to choose which ones you think work best for you and which interpretations are best. Just because one is more popular than the other doesn't mean it will work best in your strategy. Okay. Now, the next one can make you a lot of money because volatility is how we trade in the markets. Trading an asset, especially CFD or 4, that has no volatility, is not moving, doesn't do you much good. It stays below the buy and the ask and the sell price. It doesn't even cover the spread to pips. You might get it going up, but if it's not volatile enough, it's not going to move far enough for you to make profit. You need assets that have some volatility, some movement. Now, volatility is a measure of how large a movement in a given period tends to be. When, for instance, a stock makes large moves in a short period of time, it is considered to be volatile. Volatility is a very important indicator for traders because volatility makes it easier to profit due to price inefficiencies. So now we've talked about the main categories. Now, under each of these categories, we have what's called leading and lagging. And you have to know what they are, as we discussed before. Now, under trend indicators, we have moving average, convergence, and divergence. Now, they are lagging indicators. Why? Because they're using the most current price on a chart to do a calculation. So the price action had to have occurred already. But they are very good at telling you something. So, for instance, moving averages are used to identify current trends and trend reversals, as well as to set up support and resistance levels, where MACD is used to reveal changes in strength, direction, momentum, and duration. Now, if you want to be in front of the market, that's one thing. I am a trader who always want to see the trend reversal. I want to know, okay, the uptrend is over and we're moving to a downtrend. I don't care if I'm a few pips later. I want to move in when there's less risk for me. So I like lagging indicators. Leading indicators like parabolic stop and reverse are used to find potential reversals in a market price direction. Now, they work well. It depends on how you want to incorporate this in with your charts. So remember, leading give trade signals when the trend is about to start. They try to predict price by using a shorter period in their calculations, thereby leading the price movement. The most popular leading indicators are stochastics, MACD, and RSI. Lagging indicators are those that follow the price action. They give a signal after the trend or reversal has started. Use them to determine a trend. The most common lagging indicator is moving average, or simple moving averages. Now, these technical indicators measure the direction and the strength of a trend by comparing price to an established baseline. Moving averages are used to identify trends and reversals. Moving average, convergence, divergence are used to reveal changes in strength, direction, momentum, and duration of a trend. Now, these indicators are designed to show traders and investors the trend or direction of the asset that's trading. So let's go over to a live chart for a minute because I know it's getting very wordy here. And let's take a look at my candlestick charts. Okay, and let's take a look very easily today at this is the current chart for the USD JPY. Now, we are using our candlesticks here. And by drawing a simple uptrend line in the short-term Japanese candlesticks, we are now predicting a buy point. Let me just get my highlighter on here for you. Here. Now, price has moved up, and we're expecting it to come down here. And if it doesn't, bounces off this support level, we're expecting it to move up. And this will also, this price level isn't an arbitrary level. This price level, as you can see right here, would also give you the third 1, 2, 3 points in comment on a trend line. So that would make that trend line valid and active. So if price bounces off that support line and moves on that trend line, it is giving us an entry point. Okay. Now, of course, we would want to pay very close attention to our candlesticks and anything that is developing in our 2 or 3 candlesticks before we make an entry. So what we're hoping for is that our candlesticks, as they come down here, will give us some type of a buy signal. Okay, that will also verify this. We're using MACD here on our lower chart, and we can see our trend line in our MACD is supporting it. Now, we just recently got a crossover in MACD, and that was at this point to buy into this uptrend. But we're not ready because we don't have other indicators to support that decision. We also have stochastics on here, but stochastics is bounced into the middle between the 30 and 70 range, so it's not giving us any decisions at this point. But this is what we set up for. Now, using our candlesticks, we would look for our stop loss at the previous low before it reversed into a high. So remember, a trend moves in a push and an ease, a push and an ease, a push and an eve, or waves. Okay, we would look for the lowest low before it created a new high to set our stop loss, and we would set our take profit point at a point, our next resistance level, or a measure between this price movement, this price of the trend and this price movement here would give us our equal point where we would be taking profit. Because don't forget, we also have to incorporate this into our profit loss risk reward ratio by calculating the number between here, which would be our profit between this buy point, and where we would have to put our stop loss, which would be our risk, to make sure that we have enough profit to cover the potential risk, to make sure that we're either doing a 2-to-1 or 3-to-1 ratio before we enter a trade. But we have to then look at our individual profit reward ratio that's part of our trading plan. So mine may not be the same as yours, but we should always be using a 2-to-1, 3-to-1, or maybe a 5-to-1, depending on what your abilities are and what size your portfolio is. But as you can see, we've combined candlesticks together with 2 indicators that are different types of indicators. Okay, and this is how we might want to incorporate them together. But let's go on and talk about these a little bit more. You know, here we have a fairly simplistic chart. This is my teaching chart for the current US dollar. And as you can see on here, we have our Fibonacci levels on the chart. That's what we see in the purple and the blue and the green. We also have down below MACD, which is, as I keep telling you, is my favorite indicator. And we are looking for some potential in MACD, and we're looking for possibly to come in a crossover. We see that the Euro-US dollar has been moving in a downtrend. We don't have a validated downtrend at all. Okay, and we're trying to make some sense out of this market. But I can't make any sense out of possibly seeing a trade in this market. But we might wait for it to hit the upper or the lower level. So I might flip on my candlesticks to see if I can get a candlestick pattern that might support some decision here. And so right now we have virtually nothing. We have really nothing here. We see a pattern here. Now, there are ways that we can help interpret these patterns. But remember, with Japanese candlesticks, you have 32 different patterns, everything ranging from, you know, a koji to a doji to a Hammurabi to a Marubozu candle. We have single candlestick patterns, double candlestick, triples, you know, and we're looking for one of these to come together at a point that might help us generate a buy or a sell signal. Right now, we have virtually nothing on the offering here at the current euro. So we would keep watching it for something to develop. So let's go back to the chart, or let's go back to the PowerPoint a little bit, and let's talk a little bit more about these indicators and oscillators. So next we go to, like I said, momentum indicators. Now if you notice, some of these indicators fall into several different categories because you can use different parts, like MACD. You can use the histogram, you can use it for convergence, you can use it for divergence, you can use it for overbought and oversold, because that's all the information you get from a MACD indicator. So it depends on what your part of it you're using. And again, Stochastics falls over to several different categories, but there's different uses of its interpretation. So under momentum indicators, we have the leading one, which is stochastics, and then the next one, which is relative strength index, RSI. Now, stochastics is used to predict price turning points by comparing the closing price to its price range, where RSI measures an asset's recent trading strength and determines whether it's overbought or oversold. So both of these are bounded indicators. They come in between 0 and 100. Most people don't use them together. Now, there is a combination indicator called stochastics RSI, which you can use, but I have found, and a lot of people found it, because these are very, very popular. So a lot of people just use the buzzwords and put both of them on the charts and try to use both of them for interpretation. It becomes somewhat redundant. So these technical indicators may identify the speed of price movement by comparing the current closing price to previous closes. Stochastics oscillator is used to predict price turning points by comparing the closing price to its price range. Commodities Channel Index is an oscillator that helps identify price reversals, price extremes, and trend strength, whereas RSI measures recent trading strength, velocity of change in the trend, and the magnitude of the move. The momentum is a measure of the speed at which the value of a security is moving in a given period of time. So in other words, if in the last 15 minutes this asset moved a great deal, it is how much it moved or the speed at which it moved in that period of time, which is your momentum. Momentum traders focus on assets that are moving significantly in one direction on high volume. For that, they use momentum indicators such as RSI, stochastics, CCI, and Williams %R. As you can see, momentum indicators are essentially composed of oscillating indicators that are usually used to determine overbought and oversold positions. Now, again, I mentioned this earlier, we have volatility indicators. Volatility indicators are, in most cases, lagging indicators. They measure the rate of price movement regardless of direction. This is generally based on a change in the highest and the lowest historical prices. They provide useful information about the range of buying and selling that take place in a given market and help traders determine points where the market may change direction. So Bollinger Bands is my favorite. I teach a whole 1-hour class on Bollinger Bands, and basically the whole entire world of trading can be seen within a Bollinger Band. And it's used to measure highness and lowness of price relative to previous strength. Now, Bollinger Bands will help you see entry points, exit points, will help you measure the swing of the market, and everything can be found in those two bands. It's an incredibly great indicator. Then we have average true range and standard deviation. Remember, they are all lagging indicators. These technical indicators measure the rate of price movement regardless of direction. So we have Bollinger Bands, average true range, ATR, or standard deviation. Standard deviation is a very complicated mathematical calculation that nobody does by hand, computers do it. So volatility is important in trading, that you can find several different indicators that measure it or use it to generate signals. The volatility is the relative rate at which a price of a security moves up and down. A high volatility occurs when the price moves up and down quickly over a period of time. Now, if you're looking to trade an asset and you're a conservative trader, okay, and you see price movement, all your indicators are giving entry, and you see volatility is very, very high, you may say, I may not want to enter that because, or I've got to put a tight stop loss. Well, you can't afford to have volatility or high volatility in markets if you've got to place a tight stop loss to cover your risk. So you would be looking for an indicator that told you the markets had low volatility, because it would help you in placing your risk. That also works very well with candlesticks, because by using the shadows and the movement of the whole candlestick, you can actually see in a very easy graphic format how volatile the market is. So some of the volatility indicators are Bollinger Bands, envelopes, ATR, volatility channels. Okay, and Bollinger Bands, like I said, are my favorite, because Bollinger Bands contract and expand as the markets get volatile, or to show the volatility of the markets. So it helps you see in this volatility band where you would have to put your stop loss and how volatile the market is, and it may say to you, uh-oh, we can't cover that, or it's too volatile for me to make a trade in. From there, we go over to volume indicators. Volume is very, very important because you need to see how all the other traders are responding to the same price movement you're seeing. Volatility indicators measure the strength of a trend or confirm a trading direction based on some form of averaging or smoothing raw volume. The strongest trends often occur when volume increases. In fact, if the increase in trading volume can lead to a large movement in price. Now, doesn't it make sense to you if you're using candlesticks as your charting technique? Candlesticks, you're seeing a doji, you're seeing a Hammurabi, you're seeing a Marubozu, okay? You're seeing a bearish engulfing, you're seeing a hammer. Whatever you're seeing up there, it's telling you something about the trend. It's telling you something about the price movement. But don't you need something to support it? Now, doesn't it make sense to you that you should have or be using an indicator from each one of these categories? Because if the trend goes up, candlesticks are giving you a buy signal, but you see volume isn't supporting it, maybe you should say, uh-oh. Or you see that the momentum or the volatility levels are way too high for you. Okay. You need to have something that helps support your decision. So the volume of trades is a very important component to trading. It is, for example, used to confirm or infirm a continuation or change in a direction. Many indicators are also based on volume. Now, we come to the most critical of a lot of these elements, and a lot of these elements will tell us whether markets are overbought or oversold. RSI and stochastics are the primary indicators we would use. Now, as you can see on this little chart here, we have Japanese candlesticks. We can see a nice previous uptrend. This is a beautiful, easy to see uptrend. Now, what happened was, even though we're not seeing any necessary candlestick pattern, we are getting an overbought indicator from our RSI, which is telling us that this price movement has been too much and it is time, or the markets may expect to be overbought. Too many buyers are in the market, so we can expect a reversal in pattern. Now, we can look and see this. We got this slightly, we didn't get a big dip in price, but we got an end to that uptrend. So our overbought indicator helped us. Here we got an oversold indicator because it fell below 30. We can see our candlesticks gave us this one fell swoop here, and then we reversed in our candlesticks, and we also got a very definitive pattern in our candlesticks. And it's telling us the market was oversold, and here it's giving us a reversing pattern, and we could have entered, we might have exited the market if we were already in the market, or we might have been looking for an entry point to enter a market. So when a security is overbought, the implication is that buying has pushed the price too far up, and a reaction called a price pullback is expected. When an asset is oversold, the implication is just the reverse. Now, we have whole classes in using RSI and stochastics and understanding what overbought and oversold is, because it's very critical to understand this, and it takes about an hour to do this. But why do we use indicators? Indicators serve three broad functions: to alert, to confirm, and to predict. An indicator can act as an alert to study price action a little more closely. So what's it telling you? Go back and read your candles. Go back and look at the price movement. If momentum is waning, it may be a signal to watch for a break or a support. Or if there's a large positive divergence building, it may serve as an alert to watch for a resistance breakout. Indicators can be used to confirm other technical analysis tools. So in other words, if you get a pattern developing in your candlesticks that's giving you something, using an indicator will help confirm what that pattern's telling you. If there's a breakout on the price chart, a corresponding moving average crossover could serve to confirm that breakout. Or if a stock breaks support and a corresponding low on the on-balance volume could serve to confirm the weakness. Some investors and traders use indicators to predict the direction of future moves. Now, remember, indicators indicate. This may sound straightforward, But sometimes traders ignore the price action of a security and focus solely on the indicator. As I said earlier, indicators are your secondary line of defense. Price action and movement on the charts is your number one. But that is also combined with trend patterns and patterns on charts and reading your candlesticks, because that's all using direct price movement. Indicators are your second line of defense. Okay. Indicators filter price action with formulas. As such, they are derivatives and not direct reflections of price action. This should be taken into consideration when applying analysis. Any analysis of an indicator should be taken with the price action in mind. So, what is the indicator saying about the price action? Is the price action getting stronger or weaker? Even though it may be obvious when indicators generate buy and sell signals, the signal should be taken in context with other technical analysis tools. An indicator may flash a buy signal, but if the chart pattern shows a descending triangle with a series of declining peaks, it will be a false or maybe a false signal. So your price action, your candlestick charts, your price action on those candlesticks are the most important. They are the first line of defense. Okay. Your second line is your indicators. As always in technical analysis, learning how to read indicators is more than an art, or more of an art than a science. The same indicator may exhibit different behavior patterns when applied to different stocks or securities. As this expertise develops, certain nuances as well as favorite setups will become more clear. There are technically hundreds of indicators in use today, with new indicators being created every week. Technical analysis software programs come with dozens of indicators built in and even allow users to create their own. Given the amount of hype that is associated with indicators, choosing an indicator to follow can be a daunting task. Even with the indicators, an introduction of hundreds of new indicators, only a select few really work or offer different perspectives and are worthy of your attention. Strangely enough, these indicators that usually merit the most attention are those that have been around the longest time and have stood the test of time. And this is very personal, and is my personal. There are lots of people out there, and with the internet today, hawking their own trading strategy. They've taken MACD or RSI and changed it from what or how it was originally developed. You know, whether MACD is using a 12 and 26 and a 9-day moving average, they've adjusted to 10 and 24, and they're preaching it as Bill's strategy using using MACD. But the fact is, they've adjusted it, and in most cases, it may work for them here and there. Okay. But unless you're going to use the tried and true indicators, the ones that have been around the longest, the ones that have been tested for many, many years, and still use the same numeric calculations that were developed by the original developers, or like Bollinger Band, I forget the guy who brought in us MACD, Gerald Arpel. Okay. You can adjust every indicator to fit your own trading strategy, but that means you have to go to some backtesting software, backtest that indicator and your adjustments to make sure it still works in what markets it works in. Because not every indicator will work in every market. And not every indicator, it could work great for this month and next month give you nothing but losing trades, only because the markets have shifted. So understanding and learning how an indicator works inside and out, learning it yourself, not learning how to use what somebody else is preaching out there, learning how this indicator works with your candlestick charts and your patterns on your candlesticks and your chart pattern on your own will make you a more successful trader. So when choosing an indicator to use for analysis, choose carefully and moderately. Attempt to cover more than 5 indicators are usually futile. It is best to focus on 2 or 3 indicators and learn their intricacies inside and out. Try to choose indicators that complement each other instead of those that move in unison and generate the same signals. For instance, it would be redundant to use 2 indicators that are both good for showing overbought and oversold indicators, such as stochastics and RSI. But if you like overbought and oversold, you can find an indicator like MACD that has 3 different uses, and you can use it to confirm your stochastics. Okay. Both of these indicators measure momentum, and both have overbought and oversold levels. So remember, understand the difference between leading and lagging. Leading influences future performance, where lagging analyzes past performance. It's very important to understand which category they fit into when you're incorporating them into your strategy. There are clearly many benefits to using leading indicators. Early signaling for entry and exit is a major benefit. Leading indicators generate more signals and allow more opportunities to trade. Early signals can also act to forewarn against a potential strength or weakness. So there are many benefits to all of them, but this is something that takes you time. It takes effort, it takes learning, and it takes practice. But this is what will turn you into a successful trader. And if you trade with USG, they will help you all along. They have all kinds of education tools, all types of videos, all types of classes that will help you understand. And your personal account manager will help you learn how to use. They're not going to give you trading tips. They're not going to tell you what assets to trade, but they'll help you read these signals so that you can read them like a pro. So remember, combining candlesticks with simple moving averages and 1 or 2 other indicators like MACD can give you a great trading strategy. It'll give you signals, buy points, exit points, and confirmation tools. It's not that complicated. It's a matter of spending the time and effort and learning these. But remember, for technical indicators, there is a trade-off between sensitivity and consistency. In an ideal world, we want an indicator that is sensitive to price movement, gives early signals, and has few false signals. Yeah, good luck. If we increase the sensitivity by reducing the number of periods, an indicator will provide early signals, but the number of false signals will increase. So this is what I'm saying. When you use other people's strategies who adjust these periods, okay, learn how to read these, how to work with them, and then you can learn how to adjust a period. Maybe you want to change something from a 9-day to a 12-day moving average, okay, because you want some type of more short-term signal or a little bit longer term. But you'll understand how to use them, and you'll do this yourself. And you'll understand why people might use a 30, a 60, and a 90-day moving average, and how those 3 moving averages can tell you something about a market. You understand what those numbers mean. So remember, it's not complicated. It's just a little bit of effort to learn how to use these tools. Because there are many different types of oscillators. Some belong to one category or another category. Some belong to several. Okay, but pick 1 or 2. Pick maybe just because you like the names. I started with MACD because I just like moving average, convergence, and divergence. Now I swear by it. And learn how they work. Learn how to read them. Learn one at a time. And then watch them on your charts and watch how the price moves, and you can see the correlation between these movements and what they're trying to tell you. And on that note, I'm going to say goodbye. Hope you learned something. Make sure you come join us for other classes. We have a whole class on MACD. We have a whole class on Bollinger Band. We have a whole class on trend indicators and trend trading. Okay. And we'll teach you as we go along, but you have to put the effort in to master these or start somewhere. So thank you very much. Remember, if you want a recorded version, to watch a recorded version of today's class, just give us about 24 hours, and then you'll be able to find it in www.investing.com. Go to education, and then click on webinars on demand. And you can also go real quickly to www.usg.com and open up a demo account. They have the best charts out there you could possibly want to use, and you can start testing these indicators and oscillators using a demo account and start seeing how they work and start building a trading strategy for yourself. So thank you very much for joining us, and we'll talk to you again real soon. And thank you for supporting USG, the leading Forex and CFD broker from Australia, as well as being part of the Investing.com family. Have a great day now, and we'll talk to you again real soon. Bye now.